Did you know that nearly a quarter of all available shares in one of the fastest growing artificial intelligence infrastructure companies on the entire planet are actively being bet against right now? I'm talking about a stock that is coiled up like a spring, ready to explode. This is an AI giant sitting on a massive, undeniable structural advantage, directly backed by the undisputed king of chips, Nvidia itself. Yet, despite all of that, Wall Street bears are desperately trying to short this thing into oblivion. So how is it possible that some of the most respected analysts on Wall Street are now predicting a jaw-dropping 140% upside from these levels? And what happens to all those short sellers the moment this spring finally snaps? Today, we are breaking down exactly why this high-stakes standoff is happening and why the math suggests a violent upward correction could be right around the corner. Before we dive deep into the numbers, if you find this breakdown valuable, do me a quick favor and smash that like button and subscribe to the channel so you never miss an analysis like this one. It genuinely helps us out more than you know. Now, let's get into it. Let's look at exactly how the immense technical pressure on this stock is violently colliding with its fundamental reality. Over the last couple of weeks, we witnessed an intense sector-wide rotation out of high multiple AI names, driving massive volatility across the entire board. This created a high beta momentum setup where short sellers aggressively piled in, building up a massive wall of technical pressure against the stock. But here is the thing. The fundamental reality tells a completely different story. Driven by massive Google demand signals, a brilliant strategic pivot, and direct validation straight from Nvidia, top-tier analysts are now projecting up to a staggering 140% upside from current levels. Now, I know that number sounds almost too good to be true, right? Well, we are going to unpack that massive price target shortly, and I promise the reasoning behind it is even more compelling than the number itself. But to understand where this stock is going next, we first have to dissect exactly what happened during last week's brutal sell-off. In our last analysis, we mapped out a highly specific risk framework, identifying a critical put wall at $170. The warning was crystal clear. If that $170 level breaks, the bullish thesis is temporarily invalidated. And that is exactly what happened. An intense market rotation forced the stock right through our $174 to $178 target breakout zone, shattering that $170 psychological level. But here is where risk management saved the day. Our strict $168 stop-loss protected capital right before the stock plunged to an intraday low of $161.44. Now, could this have been the end of the story, a total collapse of the entire thesis? Not even close. Since then, institutional buyers aggressively stepped back in right at our confirmed $164 support zone, proving beyond a doubt that the structural floor is intact. Now, while that technical floor is holding firm, there is a massive underlying force building up beneath the surface that could send this asset absolutely parabolic. This brings us to the extreme short squeeze potential. Right now, 61.07 million shares of Nebius are being shorted, and that represents a massive 24.14% of the entire public float with a days-to-cover ratio of 3.5. Let me put that in plain, investor-friendly terms. Nearly 1/4 of all available shares are actively betting that this company is going to fail. Just think about that for a second. This creates an incredibly powerful spring mechanism, because if the company delivers even a shred of positive news, all of those short sellers will be forced to buy back their shares at a premium just to cover their losing bets, triggering a rapid, violent wave of upward buying pressure. So what could possibly light that fuse? Well, a coiled spring needs a trigger, and as it turns out, Nebius has exactly 4 massive catalysts lined up to force these short sellers into an absolute panic. We are tracking 4 distinct fundamental developments that are perfectly timed to ignite this squeeze. We have a mass demand signal coming straight from Google, a genius asset-light operational pivot, an impenetrable strategic moat built by Nvidia, and an upcoming earnings report designed to validate billions of dollars in revenue. Any one of these alone could move the needle. But all 4 hitting at once? That is a completely different kind of setup. Let's actually dig deeper into that first catalyst, because what Alphabet's top brass just revealed changes the entire landscape for cloud providers. On July 23rd, Alphabet's chief financial officer, Anat Ashkenazi, stated plainly that Google will have to heavily rely on third-party external data centers to meet its AI capacity, simply because their own internal infrastructure cannot build out fast enough. Now stop and think about what that actually means. This represents a massive demand overhang. When the absolute titans of big tech admit they have a shortfall in capacity, It acts as an undeniable macro demand signal that directly benefits independent neoclouds like Nebius, who happen to hold the exact infrastructure capacity that Google so desperately needs. When Google itself can't build fast enough, where do you think all that spillover demand is going to flow? While this macro demand is a huge tailwind, none of it matters if a company bankrupts itself trying to build all physical infrastructure. And this brings us to Wall Street's single biggest fear regarding Nebius. The primary reason the stock sold off in the first place was intense Wall Street scrutiny over Nebius's elevated capital expenditure guidance, which sat between $20 billion and $25 billion. Investors were absolutely terrified of equity dilution. But to completely neutralize this threat, Nebius just executed a brilliant asset-light pivot. Moving forward, third-party partners will finance and operate the physical data centers, while Nebius simply injects its highly profitable, proprietary AI cloud software into that partner infrastructure. This completely slashes their capital constraints while protecting current shareholders from major dilution risks. So the very thing that scared investors away might just become the reason they come rushing back. And speaking of injecting software and hardware, there is one strategic partner in Nebius's corner that gives them an undeniable moat against every single other competitor. Nvidia recently filed a Schedule 13G, officially revealing a 9.3% beneficial ownership stake in Nebius, totaling over 22.25 million shares. Now, let me be crystal clear about this. This is far more than just passive cash sitting on a balance sheet. It is an industry seal of approval. In a market where GPUs are the new oil, this relationship guarantees Nebius preferred access to highly scarce, heavily constrained GPU supplies. It immediately cements a decisive infrastructure superiority over smaller competing neoclouds. Ask yourself this: if the king of chips is putting its own money on the line, what does that tell you about where this company is headed? So, what is all of this actually worth when we translate these strategic advantages into hard price targets? With an upcoming earnings report estimated for August 6th or 10th, the street is looking for validation of Nebius's $7 billion to $9 billion annualized revenue guidance. Wall Street consensus is already rating this stock a moderate buy to a strong buy. Just look at these specific targets. Robert W. Baird initiated coverage at $250, naming them a premier full-stack provider. And even more aggressively, Northland Securities just raised their price target from $248 to an absolutely astonishing $410. That implies a staggering 124 to 140% upside from current trading levels. Now, when was the last time you saw analysts this bullish on a stock the bears were so desperately trying to kill? But that $410 target is really just the near-term picture. If we zoom out and look at the bigger vision, the path to a $100 billion valuation becomes surprisingly clear. The total addressable market, or TAM, for the global neocloud sector is projected to hit a massive $53 billion by 2030. And Nebius is strategically positioned as the premier asset to capture this global AI build-out. In fact, analysts project that if Nebius simply executes on its 2028 revenue targets, its market capitalization could easily double to reach $110 billion. Just imagine getting positioned in a company like this before that kind of growth fully plays out yet. To capture that massive market share, they have to solve the single biggest bottleneck facing every AI company on Earth right now. And what is that bottleneck? Power. Power is the absolute limiting factor for AI growth. Because if you don't have the electricity, you simply don't have a business. And Nebius is aggressively securing the grid. They are expanding from a current contracted capacity of 3.5 gigawatts to 4.0 gigawatts by the end of 2026. This includes bringing a massive 1.2 gigawatt facility in Pennsylvania online, and their long-term target scales all the way to 5.0 gigawatts by 2030, effectively securing the ultimate AI bottleneck before anyone else can. While competitors are still scrambling for capacity, Nebius is already locking down the future. But here's the real secret weapon, and it is something most investors are completely overlooking. Nebius isn't just acting as a digital landlord renting out hardware. They are rapidly evolving from a pure physical infrastructure provider into a high-margin software ecosystem. And the engine behind this entire transformation is their proprietary token factory software. It is experiencing massive market traction and adoption among developers, specifically for AI inference workloads. And the financial impact here is absolutely huge. It drives the revenue mix away from commoditized hardware rentals and towards sticky, incredibly high-margin software subscriptions. This is exactly the kind of transition that can send a company's valuation into an entirely different stratosphere. If we look at the actual financials backing up all of this expansion, the numbers are frankly staggering. Nebius is currently sitting on an almost unfathomable $40 billion in contracted revenue backlog, locked in with big tech giants like Microsoft and Meta, and they are executing flawlessly against it. Their first quarter revenue growth hit an astounding 684% year over year. Let that number sink in for a moment. To fund all of this hypergrowth without hurting shareholders, they secured a $775 million debt facility. This fully funds their near-term aggressive expansion plans while completely preserving shareholder equity. So how often do you really find a company growing this explosively while still protecting the very investors betting on it? So with all of this data now on the table, how should you actually play this setup right now? This asset presents two distinct, highly asymmetric opportunities depending entirely on your time horizon. For the short-term traders out there, this is a high beta play. You want to wait for a confirmed break back above that $174 to $178 confluence zone while utilizing tight trailing stop losses to protect your capital. Your primary goal here is to play the volatility and capture that impending 24% short float squeeze. But for the long-term investors, this is a super cycle hold. You want to look past the near-term technical volatility, rely on the fundamentally mitigated risk from that asset-light pivot, and simply buy and hold to ride the underlying infrastructure wave. Stock has a highly realistic potential to double over the next 2 to 3 years, which brings us to our final verdict on whether Nebius can actually recover and truly thrive. The bottom line is that Nebius is coiled and ready. Whether you are executing a tactical trade on that 24% short interest squeeze or investing for the long haul in that $40 billion contracted backlog, Nebius has already proven its structural resilience by holding the line at that $164 support level. Backed by Nvidia's equity, demanded by Google's capacity constraints, and strategically pivoting toward high-margin software, Nebius is undeniably one of the premier assets of the entire AI build-out. Now, before we wrap everything up, I do want to be completely transparent with you. Everything discussed in this video is for informational and educational purposes only, and it should never be taken as financial advice. I am not a licensed financial advisor, and I am not recommending that you buy or sell any security. All investing carries significant risk, including the potential loss of your capital, and past performance is absolutely no guarantee of future results. So please, always do your own thorough research and consult with a qualified financial professional before making any investment decisions. With all of that said, I'm genuinely curious to hear your take on this one. If Nebius really does deliver on that upcoming earnings report and triggers a full short squeeze, how high do you think this stock could actually climb by the end of the year? Drop your price target and your reasoning down in the comments below because I read every single one, and I love seeing where this community stands. And if this deep dive gave you a clearer picture of the Nebius opportunity, please take a second to hit that like button and subscribe to the channel with notifications turned on so you are always the first to know when the next big setup appears. Thanks so much for watching, and I'll see you in the next one.